Mannik. Welcome to the show.
Hey, thank you for having me.
So, why don't you give everybody a bit about your background? You're a BBA in finance from the University of Georgia. You joined Victory back in 2015. Today, you're president of investment franchises and solutions and head of ETFs. So, can you walk us kind of through how that whole journey unfolded?
Sure. Well, as you mentioned, I did go to the University of Georgia, and that's where I got my finance degree. I originally started out as pre-med. Growing up, you don't really hear about roles like, we have in asset management, right? You hear about, maybe nowadays you might hear about hedge funds and things like that, but normally, like, I don't think anybody even knows a role exists. So you ask a little kid who you want to be when you grow up, you want to say, hey, I want to run an ETF business, right? They probably just don't know about it. So I did that at first, pre-med, but I always had this knack for financial markets. And I started trading some stocks in college, right around the tech kind of boom. And I knew that, okay, that was a better, path for me. So I switched to finance, and I loved it, and came out, and my first job coming out was with a firm called Hewitt. They're now Aon. And it was working with their defined contribution clients and building their plans and lineups and things like that. So on the consulting side, did that for, I was with them for 8-9 years, eventually moving into dedicated manager research. So that's where I started the point in my career where my job was to evaluate asset managers like Victory Capital and recommend their strategies to our clients. So that was a great experience. I took that to Wilshire Associates, where I was head of manager research. So eventually I went from Atlanta to Chicago, then now to Santa Monica. And again, got to meet with the best of the best in the industry. I think it was a really great role to learn the business of asset management. It gave me access to some of the most senior people, CEOs, CIOs, COOs of firms across the globe. I visited different parts of the world doing manager due diligence on site. And so it was a really great learning experience. And it really helped me figure out kind of what I wanted to do or in my next phase or role and kind of what that company should look like. So, because I had the opportunity now to see thousands and thousands of different business models. So then when I came across, Victory was known to me because we used to use them in some of our multi-manager funds at Wilshire. So I knew the folks at Victory. We worked on a couple of projects together. And then the conversation really began around, the model that Victory was building in its private state. So Victory Capital became independent of KeyBank back in 2013. Actually, on the 31st was 13-year anniversary of that. And the idea was create a new version of asset management where you can find the best and skilled managers with edge, but leave them alone to do what they do best, which is manage money. In asset management, one of the things I learned in the research side is, especially smaller boutiques, the investors are dealing with other things, like they're dealing with HR and accounting and all this other stuff, and it does take time away. And then if you have these large firms that are built off of one research process, you kind of get groupthink across the portfolios, right? So this way, we have independent autonomous investment boutiques that we call franchises that operate their process and management teams independently and autonomous. And I'm there to help them be a best practice kind of provider, be counsel where they need, but really it's up to them to drive their process and team. And then we support them with everything else. So they don't have to, worry about managing a distribution team or marketing or, what are compliance best practices. And so that was a model that resonated with me. And that's why I decided to take on, at the time, what was a head of product role at Victory Capital. And that's now grown, obviously, since then. And part of that growth has come, to other areas like overseeing the investment franchises, to the solutions business, to also the ETFs.
Great. So before we get a little bit deeper into the product lineup and the ETFs we're going to talk about today, I ask everybody this: when you're not behind the desk, what do you do outside of work? Any hobbies?
Yeah, when I have time for hobbies, right? I mean, that's the other thing. Outside of work, I try to spend as much time as I can with my family. We all here at Victory work hard. We travel a lot. So when I'm actually in town or, on the weekends, I like to spend time with them, catching up and, there's a lot of and now as they're turning into teenagers, there's a lot of kind of hopefully dad moments where I can provide some knowledge and insight to them. And so like doing all kinds of things with them. Um, you know, I used to play golf, but don't have the time anymore. I like cars, things like that, but no specific hobby that I would say, hey, I do this every day or every week regularly, other than try to spend time with my family.
Yeah, it seems to be the growing theme. Everybody's so busy anymore, just try to spend time with the
Yeah.
family. But let's talk about Victory Capital. You touched on this, but I think it's super unique because I've talked to over probably 100 firms now, and you're running like this multi-boutique model with independent investment franchises. I know you touched on it, but can you just go into that a little bit more? Because it is super unique.
So, going back to like when I was evaluating managers for institutional clients, we always liked the boutique structure where it was a small firm. They focused on a few things in one corner of the market, right? And we felt that, okay, that leads to specialization. It leads to a level of expertise that should drive performance over time. But what we didn't like as institutional consultants is small firms don't have the infrastructure, right? The operational due diligence gets difficult. The compliance due diligence gets difficult. And so particularly post '08, that became very important to clients because some of those smaller boutiques that were, good at what they were doing went out of business because, the market declined so significantly, right? They just couldn't survive. But I truly believe in, and we believe in, that if you find those managers that are good at what they do, they've exhibited skill, have an edge, you can keep them isolated from the noise of everything else that goes along with asset management and let them focus on generating returns for clients and servicing their clients. And that's kind of what we've done. So that the other benefit of it is if somebody comes to Victory Capital to buy an investment product from us from either multiple franchises or the solutions team, they're not getting the same process at all. So in fact, like we get asked this a lot of times around, hey, do you have overlap then of your strategies and products? And we do. And, we actually embrace it because even in the same asset class, different processes, different teams lead to different results, or at least the path is very different. And so we basically allows the clients to have the choice of which approach they want. And we have many clients that own multiple products from Victory Capital from multiple franchises because of that. So I think but then you need to support those franchises with all of the other things that are very important to clients. You have to be able to go out and tell the story through your sales team. You have to be able to create marketing collateral. You have to be able to run and operate the business in terms of operations, trading, all those things that go along with it. And so that's how we put that layer below the franchises to support them. Our model, our centralized platform, while it's centralized, it's not standardized. So we're very customized in how we work with our franchises. Some like things a certain way, some need certain help on certain things more than others. And so it's very customized, not standardized platform off which they can kind of grow their businesses.
So why don't we get into VFLO, the Victory Shares Free Cash Flow ETF. You guys launched this June of 2023. It tracks your Victory US Large Cap Free Cash Flow Index. At a high level, what is this fund and what problem is it trying to solve for investors?
So the way we came out with this fund, I mean, we recognized that free cash flow had gathered acceptance in the industry as a value metric, right? And we think as a better value metric. And so you'd seen a lot of assets go into some of the other products that are out there in the marketplace that follow a free cash flow yield approach. But we also, like, when we were sitting down and looking at that, realized, and this is a function of all the active quantitative work that the solutions team does, that there are better ways to go about capturing that free cash flow yield or measuring it. And then also adjustments you can make to your portfolio, your list of securities that avoid certain things like the value trap that you sometimes run into with value investing. So VFLO sits squarely in the large value space. That's how clients are using it. That's where it fits, but it's a better way of measuring value than some of your traditional price to book, price to earning type approaches. And then along the way, whenever we've come out with a new rules-based product, we have to say, what are we doing to make it better? So you identify a challenge, or maybe, I don't want to say a deficiency, but like something that can be improved upon, and then say, how can we then make this better so that the clients, ultimately it's about the risk adjusted outcome that they get, and how can we improve upon it? So that's really how VFLO came about. We said, hey, free cash flow yield is a great measure. There's a better way to do it. And then we launched our product just over 3 years ago.
Why don't we get into the index methodology just a little bit more? So you're not just ranking stocks by free cash flow yield. You've also layered in this, growth expectations as well. So how does that combination actually work?
Sure. So a couple of the enhancements we made, and you hit on one of them. So the first thing was, the products that existed out in the marketplace, when they were measuring free cash flow yield, or they still are, they look in the rearview mirror only. And, while history is a good indicator with how dynamic markets are and how quickly businesses are changing, we felt a free cash flow yield approach that looks in the rearview mirror only can be improved by also incorporating forward estimates of free cash flow so that you can catch points of inflection in a business. Take, very simple example is during COVID, Moderna, during that time, they were flush with cash because of all the vaccines, and then quickly their free cash flow profile turned around, and with a rear view looking approach, you would have missed that. And so having that is one enhancement that has really helped with results. And the second is the one you were touching on, which is the growth filter, really. So it's less about finding the best growing companies. It's about getting rid of the worst growers so we don't end up accidentally in a value trap.
Right.
And, what that's done is really allowed the strategy, the index, and the fund to outperform in what's been a really growth kind of headwind for value managers, right, and value strategies. And interestingly enough, when it completed its first 3 years, being able to outperform not only your style benchmark in the value space, but also core and growth benchmarks over that period of time, and doing it without any Mag 7, like that's a pretty compelling, I think, solution for clients.
Yeah, I would agree. And we'll touch base on that growth here in a second. But I was looking through the holdings. I know you're not allowed to talk about specific tickers, but I was curious, like, why do some names screen well on free cash flow framework when they might not on like that classic value metric?
Well, I mean, there's a couple ways too, right? So oftentimes there's some similarities, right? You'll look at a price to book based approach, and it'll lead you to the same place that free cash flow yield will. The difference, though, is, one, price to book fails to capture some of the evolution that companies have gone through in the marketplace, right? So now you're having companies, it's not about tangible assets on the books anymore. There's a lot of IP, there's intangibles, there's future growth opportunities. So there's a lot more that goes into determining what is a good company for the long run than just the assets they have in their book and what price you're paying for them, right? So given technology is a perfect example, right? It's not about brick and mortar buildings and widgets, it's about way more than that. And so free cash flow is a better measure in that regard. And that leads to some of those differences you see between a standard price to book approach and maybe a free cash flow yield approach. The other thing is the growth filter does matter. And so what you'll see is, well, free cash flow is great because it's the money that's left over after companies paid its bills, right? So it is a true, pure representation of a company's ability to generate returns for clients, really, or cash, right, in this case. And it removes a lot of the other noise that happens in the accounting of income statements and balance sheets and things like that. So it's very pure in our regard. And then when you take that, you could say, okay, well, I found a company with great free cash flow yield, so it must be great. The problem is maybe that yield is really attractive because there's something wrong with the company that is going to not only persist, but maybe even get worse, right? So you want attractive free cash flow yield, but you don't want it, you don't necessarily want the yield to necessarily go higher just because your price is declining, right? So in that case, what we found is just get rid of the worst growers. That tail that where these companies are not exhibiting growth. So then you could say, okay, not only are you generating a lot of free cash flow, you have a very disciplined way of managing your business, but you're not in that trap or in that kind of circling the drain around growth. So that leads to how these companies do. And so what happens every quarter when we rebalance, you'll see a healthy number of changes. Companies are being dropped, companies are being added because free cash flow yield changes over the quarter, but plus so does growth prospects. And so we try to capture both of them in a rebalance.
Interesting. But you touched on this, a little bit. The results have been remarkable, right? VFLO has grown to roughly 6 to 9 billion in assets in 3 years. That puts it in kind of one of the top tiers of ETF launches, this decade. Outside of performance, which, as you've mentioned, has been incredible. What do you think is also driving adoption of this type of product?
Well, one, it's an easy to understand process. Free cash flow is not something we have to go really explain to people. It's understood. We're just capturing it in a different way than some of our peers. So I think from an ability to understand the methodology, it's not that hard, right? So anytime we've set out to do a rules-based product out of the solutions team at Victory, there is one belief we have, which is you don't have to be overly complex to drive outcomes. And so sometimes I think, especially quantitative investors can get stuck in the, creating this black box that even maybe sometimes they can't even explain how it works. And so we kept it simple. So the simple story helps in conveying the value proposition for the product, right? So there's not a lot of hoops to jump through for the buyer to understand how it works. So that's definitely one. Second is we have a fantastic sales team. Our intermediary sales team is well resourced, well experienced, has great relationships in the market. We have a dedicated RIA sales team, and with any new ETF launch, that's an important channel in the retail space. So they're out there doing that. But we've spent so much time educating and training them before they're going out into the field that helps. So we have basically subject matter experts in their own regard, have the confidence to go into their relationship and talk to them how this can benefit them. A lot of it is also cross-sell from other products. Like I mentioned, advisors have other products from Victory Capital, so they might know us for maybe our global strategy, or maybe they bought another ETF from us before, and we're going in there and telling them about the new approach. That's helped. The marketing collateral is also very important. I think we have a great marketing team at Victory Capital where, the ability to take what are technical concepts and distill them down into a way that, an end client even can understand, I think is very important. So having clear collateral that's easy to understand and shows the value proposition has been another thing. Now you put all that together with obviously now great, a real, 3-year live record, 5-star rating. I think, the adoption is only going to be better from here.
Yeah. The landscape in this area is also like pretty competitive. We've had a competitor of yours on the show. They have a huge following. They've had the CTF out since like 2016. Yep. What are you guys doing differently as you think about like this particular competitive landscape? Is it the growth filter? Like is that the differentiation between this product and maybe some of the other large ones that are in the space?
Yeah, it's that and that forward looking on the free cash flow. So being able to not only focus on historical results, but looking at forward free cash flow estimates is very important. That's been a driver of performance and outperformance. But you also said it, the growth filter is one point of differentiation. And I think it's important to know that doesn't push the fund into growth territory. It's just basically trying to say you don't want that anchor or drag from these companies that truly are cheap for a reason.
So you guys have built a whole suite around this idea, right? You have VFLO and large cap, you have SFLO and small cap, and GFLW and large cap growth. So can you talk about like that philosophy and extending the same framework across different market caps and styles? And are we going to see more variations of this particular idea from Victory and maybe other styles as we look forward?
Yeah, absolutely. We also have IFLO and GRIN, which are the international versions of it too, and those really came about because clients had asked us, hey, have you thought about it? And, honestly, the answer was yes, we thought about it. From when we did the R&D for the original product. Maybe it's coming from my institutional consulting days, but one of the requirements that I have when I sit down with a quantitative team, and in this case, the solutions team building rules-based products, is look, you can't come to me with a methodology that only works in one corner of the market. If it's a sound rules-based methodology, it should work across asset classes. And that was one of the first things that the team had to convince me of, that we could apply our process across market caps, styles, and geographies. And it did work, in our research. And so when those clients started asking about international, it's one of those, hey, glad you asked. Like, we actually have already done the work. We know the approach can work. And so we launched those products. So now we have a pretty healthy suite. You have large value, you have large growth, you have small cap. We're doing some research around small growth, if what can be done there. And then we have international value, international growth. So we got the right building blocks going for the flagship free cash flow approach. I think what you'll see down the road is there's a lot of opportunities for us to augment what we do for different types of client needs, right? So for example, is there a way to enhance the income? Because, free cash flow yield isn't necessarily around dividend income. Now, companies that generate high free cash flow can pay dividends, but it's not, your high yielding dividend type story necessarily. Is there a way to augment maybe the securities underneath with maybe derivatives based income or something like that? One of the things in the flagship methodology, we don't include financials and REITs. And it's for a very good reason, because free cash flow is not a good measure for financials. That's another area where, we've had some clients ask us, would we be willing to do one that's maybe a little more core-like, or maybe more complete from a sector perspective. Obviously, our research shows that, when you have conviction in a process and a methodology, just like active fundamental managers, you want to build a concentrated portfolio. And, as long as you can compensate for the risk you're taking, that's a great product. But, some clients feel that, maybe having financials and stuff is better, but it's something that, we've looked at. But, it's always going to be, I think, an easy enough to understand concept, so where it does have opportunities to add offshoots from it in the future. Another one we got asked about is running it as a global strategy, which obviously we would be able to do because we have, the geographic capabilities already out there.
So if you're an advisor thinking about VFLO, like, how should they use this in their portfolio? Is this a value sleeve? Is it a core replacement? Like, where would you advise somebody with an already diversified model portfolio to put this?
Sure. Look, I recognize that every portfolio is going to need beta. You're going to have beta, right? You get a little bit of beta, low cost beta. You aren't taking a lot of tracking error. You're taking no tracking error. So we understand that. But that comes with, other challenges. So for example, you could have an S&P 500 allocation today and a NASDAQ 100 allocation. And actually, for a long period of time, you were probably in the same stocks and you're probably doubling down on some of those larger stocks. So whether it's, something on the growth side like the NASDAQ 100 or Russell 1000 growth, or it's in the core space like the S&P 500, we've seen the issues with concentration that have existed. So the concept of we can give you a product that can still outperform. Now, here's the important thing about, how the growth filter and everything works together is, generally value strategies using the old metrics, they do well in value environments. The problem has been they give it all back in a growth environment. And that's where, the growth filter, just getting rid of the worst growers, comes into play, because what it's actually allowed VFLO to do is not only do well in those value-oriented markets, but keep pace in growth-led markets. And what that means for a client is they can still get their growth out of, let's say, a NASDAQ 100 or an S&P 500 type. S&P 500 is blend, but a lot of it's growthy, so it's like it just changes where the style marker comes in. But, they can look to diversify away. So for example, I mentioned earlier, VFLO has produced the track record it has with no Mag 7 exposure.
Right.
And I bet you most portfolios somewhere in there have a good bit of Mag 7 exposure, just either through index beta investing, or maybe even active large growth. So what we've seen is, it gives people comfort to be able to say, look, I understand, even though value's underperformed for so long, okay, I can see how this approach won't leave me wishing I hadn't invested in value if growth continues to run. And it's also driving results without some of the same stocks I own in a lot of other places in my portfolio. And then we also have the growth product. So a lot of clients have actually paired the two together. Pairing the value version with the growth version, so VFLO with GFLW, has been a great pairing for certain clients. And then what they can do is they can keep that center part of their portfolio in low cost beta if they want, and they're getting something very different.
Mannik, I really appreciate you spending some time with me today. Before I can let you go, though, where can people learn more about Victory Capital and your entire suite of products?
VCM.com is the best place.
All right. Well, again, thanks for spending some time with me today.
All right. Thank you very much. Appreciate it.